Welcome. My name is Will Goodhart. I'm a member of the Board of Trustees at the CFA Institute Research Foundation. It's my pleasure today to be joined by the four authors of the recent brief on infrastructure debt, alternative credit to finance the future, to talk about their work and to tell us a bit more about the world of infrastructure debt and how it has developed and is likely to evolve in the near future. Our authors are Alfonso Ricciardelli, and Alfonso, I think you're based in Singapore, where you work with Endowus, a fintech wealth management platform, while you're also studying at the National University there. You have a background in hedge funds and hold the CFA charter, the KIA designation, and also the certificate in ESG investing. Phil Clements, you're also a CFA and a KIA, and an FDP, I think. And after time at both Record and Bloomberg, you're now also working in fintech, but this time with an emphasis on regtech, I guess. And Simon Beckman, you're the senior VP at DNB, responsible for renewables and infrastructure finance. Welcome. And Matthieu, LeBret, welcome. You're the MD and global head of structured credit distribution at NordLB, responsible for bringing structured energy and transition opportunities to institutions. And you're a KIA and FRM holder. So my first question is actually how the four of you met and decided to work on this. Phil, I don't know if you want to take that one.
Yeah, thank you. Thank you for having us here today. It actually goes all the way back to about 2023, 2024, when myself and Alfonso were both living in New York at the time. We were regular CFA New York event goers, and we happened to bump into each other and became quite good friends. And we both realized that at that time, we were both working in the alternative credit space. And we shared this sort of view that the content or information in the market surrounding alternative credit was lacking. And so as a result of that, we actually wrote or co-authored another brief that was released in March 2024 called the Introduction to Alternative Credit. And that actually became one of the most widely viewed briefs on the CFA Institute Research Foundation platform. We actually wrote that with 7 other practitioners that covered a variety of different asset classes like direct lending, CLOs, trade finance, and infrastructure debt. And then we realized that some of these sub-asset classes within that brief were actually very, very important, becoming very topical in the market, and they actually probably warranted their own brief or their own guide in of themselves beyond just the 15 pages that were dedicated to each of those different sub-asset classes. And so it was for that reason that we decided to embark on creating an independent piece related to infrastructure debt. And it's through Alfonso that I met Simon from DNB Bank, who brings in a lot of expertise around Nordic energy project finance, Matthieu in NordLB, who looks after the investment solutions across infrastructure debt. So we brought in some authors or practitioners in the market who could really lend their expertise to helping us write this.
Great. Well, thank you all for your work. I enjoyed the brief very much and found it extremely useful. But apart from me, who do you think this is for? And what do you think the readers will learn from it? I don't know, maybe Simon, do you want to pick that one up?
Sure. Thanks for hosting us, Will. And no, I think it's quite clear that this brief contains a pretty broad outlay of the infrastructure debt asset class. And I think as such, it is indeed for the practitioner, but maybe more on the institutional investor side that may start dipping its toes into this asset class and consider what different kinds of infrastructure debt is out there and what specific dynamics and features that they host, as well as risks and how that fit with their broader portfolio. Now, aside from that, I can also see that there is a value for regulators and for other service providers into the sector, which may not be core to the infrastructure part, but may host us as a part of their broader offered services.
Thank you. And I guess, do you think the recent events in sort of the Gulf region have made an understanding of this market even sort of maybe more important than it has been before? I don't know, Alfonso, if you want to perhaps pick that up for us. The brief mentions political instability as a risk to energy infrastructure, but I don't think it actually mentions sort of the potential for outright war.
Yeah, I mean, nobody expected that, right? And I guess when we started writing this briefing, the political situation was very different, even in terms of what clean energy represents, right? There was a big push. Don't know if you guys remember the Biden presidency back then for clean energy. Europe continues to have that push, but generally speaking, I think and beyond what's happening right now, there are certain countries and certain economic areas which continue to attempt to build not just new clean energy projects, but generally speaking, energy infrastructure, because it's so strategically important, right? So I think that even though the timing of the briefing when we started writing it was very different, it is still a very timely topic, and now probably even more so. And I guess we'll know more about this as we continue in this interview.
Yes, I mean, I think I read recently that there are as many as 80 energy assets in the sort of Gulf region that again need sort of repair, and so I guess that's maybe a new form of infrastructure financing and sort of repairing facilities that were previously functioning. But the brief sort of mentions that the sector is clearly moving from being sort of more of a niche interest to becoming much more central, as it sort of overlaps, I guess, with a number of significant trends. The need for governments to spend on infrastructure, partly to prime growth, the energy transition, as you've mentioned, the growth of AI, and the consequent need for data centers. And so I guess, Matthieu, my question would be sort of where do you think infrastructure debt fits in portfolios now? Is it part of private debt? Is it part of real estate? Is it a separate asset class unto itself? I'd be very grateful for sort of your understanding of where the asset owner, the institutional community is on this at the moment.
Well, thanks a lot for having us. First of all, the reason institutional investors focus more and more on infrastructure debt is for once that it's a diversification play. And so in a world where market risk is a significant component of total risk and total return, infrastructure investments provide very good diversification and low correlation in terms of risk return. Second, it's more of a pull factor, but we see that first governments are all in heavy debt worldwide, and the cost of this infrastructure to build is extremely high and only getting higher. Now the banks are also increasingly subject to a kind of cap in their total assets and have to manage their scarce resources. And this creates an opportunity for institutional investors to step in. So one side is that it's a good investment, but the other side is that there is a space, and actually the two work in tandem. If we look at the typical investor that I speak to, so the mid-market European pension fund, let's say 3-4 billion euros under management, they would typically dedicate 10 to 15% of their assets under management, of their allocation, to infrastructure. Within infrastructure, historically, most of it has been equity allocation, because this provided equity-like returns without the volatility of financial markets. That being said, increasingly they realize that they need yield, and yield is not necessarily provided by new infrastructure that is still going through a construction phase. And for this, infrastructure debt becomes a very strong value proposition. So there is a space left by banks. There is a need from governments and banks that infrastructure needs to be funded. And there is an attractive risk-return value proposition. And all this together probably explains quite well the recent increase in allocations towards infra debt.
Yeah. And
Yeah,
if I just add to that, I think, because I think me and you are the two Brits on the call, but I think about the UK specifically, where I live, you had things like the Mansion House Accord, right, in 2025, where 17 workplace pension providers committed to investing at least 10% of their defined contribution default pension fund assets in private markets, and it specifically called out infrastructure explicitly as one of those asset classes. And if you think about around the same time, or just a few years earlier, I think it was 2021, the UK government set up UK Infrastructure Bank to the tune of 22 billion, now part of the UK National Wealth Fund. So to Matteu's point, there's a huge impetus by local regional government to actually encourage allocators to invest in these asset classes. And the UK, I think if you look at the aggregate of the defined benefit and the DC pensions, you're talking in the billions, if not more than 100 billion of assets that can potentially be flowing into infrastructure over the next 5 to 10 years.
Yeah. And asset owners who are looking for the kind of long duration asset that infrastructure probably represents, I guess, as well. So Matthieu, you talked about your typical sort of client base maybe having an allocation of 10%, or was it 10% or 15%? I think it was 10% that you said.
15, yes.
15. My apologies. Do you think that's going up? I mean, and what is it replacing?
I think for the time being, it's not going up, because it's still a relatively new asset class as an investable investment universe. So the trick is at the moment for investors to select the right way, the right entry point into the asset class. Also, infrastructure is very broad, and the types of value propositions depends a lot on the way you approach the asset class. So for example, if you finance projects directly, you'd have a very low default rate, high recovery, but at the same time, lower return. If you provide back leverage, so lending, for example, to the holding companies that invest into those projects as equity investors, the return would be much higher, but at the same time, the volatility of return and the risk would also be higher. And so at the moment, we observe definitely increased interest for the asset class, and this is why it's highly topical for us to provide this brief. But at the same time, there's still a learning curve that investors are going through in learning to navigate the asset class and the different value propositions that are into it.
Yeah, no, thank you. And I think that the brief acts as a very good guide, almost in sort of introduction to the asset class. On that basis, do you think there is a typical part of the market which is often an entry point for institutions who are looking at this for the first time, or looking to move sort of into it in greater depth? I don't know if Matthieu, if you want to take that, or Simon, or the two of you between you maybe.
Yeah, I can start, and Simon will definitely complement. There are two entry points as I see them. One is the liquid part of infrastructure debt, so the project bonds, because they have an external rating, and they're dealing with usually operating projects, and so they're relatively easier to understand in terms of risk return, also safer and more liquid. Then the other side is the high yield infra debt with holdco financing and mezz financing. This part of the market is probably closer to private credit at large, but with the recovery experience that's much better, because you have the cash flows of an underlying infrastructure asset to back the recovery and the repayment capability of the borrowers.
Great, thank you. I can Simon, if you have something to add, yeah.
Yeah, no, I can add shortly to that. And I think that is also a trend that we've seen, that with the sophistication, both on the investor side, but also the sort of the maturing of the various sub-segments in this asset class, you have seen investors being increasingly comfortable taking risks that were previously deemed to have been outside the scope of their risk remit. And here we could talk about development risk, we could talk about construction risk, and you can talk about various types of project risks that obviously impacts in the front end of the curve, the cash flow stability and the completion risk. But having that sort of certainty of delivery at an early stage is key for the operators and the owners of the asset. So to the extent that that is a risk that institutional investors can digest, they can more increasingly early also compete with conventional bank lending or project finance. So that is, I think, a trend which we've also seen in the latter years.
Great, thank you. I guess I've got a couple of questions. One is sort of about the defensive nature or the sort of the historic risk assessment of infrastructure debt at a time of maybe increasing pace of technological change. And then also a question actually about sort of bank finance and whether that bank finance is going to compete more with capital markets as regulation on bank capital is perhaps eased, as we've heard suggestions in various markets. But I don't know, Alfonso, do you want to pick up? I mean, the infrastructure debt assets are long duration assets, but given the pace of technology change that we're seeing, things like sort of wind turbine capacity, sort of or generating potential increasing very significantly. So, if you invest in a wind farm, is it going to be technologically viable in a period of time, or the very rapid developments that we're seeing in battery technology and potential shift from sort of lithium ion to sodium ion within data centers? All of this seems to be happening very quickly. Does that make investing in infrastructure debt potentially riskier than it might appear from the outset?
Well, I will. This is a great question, and I think on the more technical part, I think Simon is probably more a better person than me. What I would say, more generally speaking, is that rates have a massive impact on these projects, financing rates especially. And I think that, again, Simon will probably have be more thorough on this topic. But while we used to be worried about the price of oil back in the days, I think when it comes to especially new energy, clean energy infrastructure projects, we have to look at interest rates. And I'm sorry to steal your job, Will, for a second, but I'll pass it on to Simon, who can probably finagle this one.
No, certainly, and I think, I mean, it is a good question how investors regard technology risk. I think there are, of course, mature technologies such as both turbines as well as solar PV technology, which, while it has experienced significant technological advancements in the last 10 to 15 to 20 years, those have typically been incremental. They haven't been sort of tectonic in that sense. So I think that is obviously something which makes investors more comfortable that there will be continuity. But of course, if we look at more clean energy, if you have a groundbreaking change, be that on hydrogen production, and you mentioned, of course, battery technologies going from lithium ion to sodium ion, and there are, of course, other competing technologies for it. I think those are still fairly nascent, and I think at least from a practitioner's point of view, we see no trend or no signs that there would be reduced appetite to invest in these assets merely for the reason of technology risk. Of course, that is a compounding issue which is taking well into account when you look into residual value risk, and the revenue profile of these markets obviously are quite front tilted for various reasons, which I'm happy to come back to. But that also makes it more scrutinized, I think, by both banks and institutional investors alike. And there is, of course, a natural conflict of sorts in making sure who actually get de-risked ahead of the other, which would typically be the bank. But as we have seen from recent experience, I mean, this is a lot about what sort of conviction you feel about the forward curves in the market and so on. But I'll pause there and see if there are any follow-on questions to that.
Maybe we can also mention that the typical economics of infrastructure is that the building thereof is extremely expensive and difficult to achieve. But once you have infrastructure in place, the cash flows tend to come quite easily. And so even if the financial model is very often a bit too optimistic, actually the profitability of infrastructure once it's built is usually quite high because it's semi-monopolistic situations, or in the case of renewable energy, very low cost of production. And so you make a margin. This margin may be huge, this margin may be just strong, but there is a margin. And that creates a kind of immunity to obsolescence and technology breaks, because even the solar panels of 5 years ago, the turbines of 3 years ago, produce very cheap energy. The last point is that infrastructure is typically positively correlated to shocks. And so when you have a pandemic, then you have a war in the Middle East, you have challenges throughout the world every year, every 2 years. It's actually quite beneficial in terms of increase in electricity costs, which therefore makes those renewable energy projects more valuable to the community and also to the sponsor and the investors.
Yeah, no, thank you. And I guess just to come back to the question about sort of bank lending, do you see banks being likely to be competing more for assets, or do they sort of inhabit a different part of the market, sort of earlier phase, or are they going to be competing with institutions for the same kinds of assets?
Maybe I can start with this. I think it's a live issue, right? It's I think that was only last month in March of 26 that the US regulators got together and revised the Basel III endgame proposal, which would mean that they would quite modestly reduce some of the capital requirements on large banks and some of the, even for some smaller banks as well. And I think there's been some sentiment out of UK and Europe to sort of do the same, which really clearly points towards some easing essentially. And so if banks can now hold what is essentially long-term infrastructure loans much more cheaply on their balance sheet, and they can compete in that market more aggressively, then they're absolutely going to do so. Because if you think about the funds that have been set up and all the infrastructure around those funds as a result of Basel III when it first came in, you know, that's their bread and butter, that's the yield that they're making. So if banks can capitalize on some of that, then that's great for them. I think to counter that, I would say I don't think this displaces non-bank capital. I think there's already been a massive structural shift in the market already, and now you've seen all these private infrastructure debt funds and long-dated liquid funds already in the market. They've been here for a number of years. They've got their own infrastructure outside the regular banking system they've already set up. So they're here to stay. It just means there's going to be more competition, so maybe compression in yields, but also that might be a good thing for the end allocator. So I think it's a good sign that banks can step in, and typically I think also in areas like the pre-construction financing that I think Simon alluded to earlier, that's where banks maybe have a bit more of the risk appetite or the balance sheet to weather that sort of storm where maybe some allocators can't.
Yeah, I just wanted to add to Philip that is obviously something that pertains to the entire private credit space, right? I mean, competition, and I think it's a precise policy goal in the United States to bring the banks back into the mix. What I would argue, though, here is that infrastructure has a capital deficit in general. So I don't think that increasing capital in the space is a bad thing per se. I'll stop at this.
Yeah, no, thank you. Sorry, Matthieu.
There is also So a relatively underbanked part of the market, which is the lower mid-market segment and the smaller projects. So for very large utility-grade projects, there is plenty of capital, but for smaller sponsors with smaller projects and more complex needs, for example, some bespoke capital solutions, the banks usually struggle, both from a capital standpoint and from a usage of resources standpoint. So it takes more or less the same cost from a bank perspective to structure a 200 million ticket or a 40 million ticket. And there, the non-bank investors, and in particular the funds, if they are specialized enough, have a very strong role to play, because on one side, they are specialists, and so they can help those investors who want to allocate to the asset class to navigate the market. And at the same time, they occupy a space that is not and probably cannot be used by, cannot be occupied by banks that have a kind of minimal critical mass to achieve before looking at a project.
I can just add quickly as well that I think it's not necessarily that there's a clash or there is fierce competition between the sort of private credit investor and the conventional bank lending, because typically you would see them in particular for true infrastructure assets. If we take, for example, the Nordic angle, we have a vibrant district heating asset space, right? And here you can see clearly that you've had typically the well, as I believe Matthieu was alluding to earlier as well, that you have, of course, the operational debt provided typically in a project finance structure, but then you have multiple capital layers on top of it, funding the equity contributions into the operational vehicle. So there you can have a highly complementary nature between the private credit investor and the bank lenders, and that may occur in the form of high yield issuances, or it may occur in the form of direct lending or otherwise.
Great, thank you. And in the you talk about the sort of the Nordic market a bit, and you provide a very good case study in the brief on that. And elsewhere in the report, you also write that a renewable project that appears profitable in a simple financial model may struggle once more realistic factors are included. I just wondered if you could give us a sense of those realistic factors that can be quite difficult to introduce into a sort of strict financial model, and how investors can perhaps seek to model with greater levels of realism.
Yeah. No, and I think first things first, I think calling a project finance financial model simple is probably hyperbole, but nonetheless, I think the case that we tried to make in making this case study was the fact that, and this sort of demands taking you a bit behind the curtains of, how the power markets and how the power grid in the Nordic frame looks like, right? So historically, I mean, as most people are probably aware, we have a large hydro reservoirs, which is obviously contributing to a large degree to the baseload power generation in the Nordics. And then you've had obviously, flexible demand being covered from turbines, from gas-driven or other types of generation. But of course, with the increased penetration of intermittent renewables such as wind and solar, that production profile in the grid has largely changed. And you have also very different demand centers compared to the supply generation, which are focused geographically in different regions and then impacted by bottlenecks in the various countries, right? So this gets you a very sort of peculiar dynamic, particularly around achieved prices, which are quite lower than what the sort of screen spot rates are, and this is driven by the cannibalization risk, or capture rate price, as we call it as well. And this is basically that when you produce, everybody else produce, and when nobody produce, you don't produce either. And so since we have marginal cost price setting in the power markets, you will have very tilted prices throughout the 24 hours of the day. And this is, of course, something which both power price forecast providers are increasingly granularizing and providing good data on. But of course, the legacy data that we have from the last 20 years looks nothing from what it will look in the next 5 or 10 years, right? So this is just one. And then you have, of course, other basis risk, where you look at, the distinction between the system price and the node price. And so there are all of these peculiar risk dynamics, which was not necessarily an issue for the investor that came to the market 10 years ago, which is now ever present, and that needs careful consideration. And now that is being mitigated partly by the entrance of large-scale storage in the form of battery, which gets increasingly co-located with solar and wind. So that can offset some of those risks. But again, the more complex the structures, the more complex the assets, the more complex the power grid, the more careful due diligence the common investor needs to make as well.
Thank you. And you refer to sort of peculiar risk characteristics that wouldn't have been present in this market 10 years ago, and you talk about sort of the current risk mix as you see it as a group of authors within the brief, and I guess if there's a risk that you can sort of foresee that you don't really cover in the report, but if you came back and had to rewrite it again in 10 years' time, what do you think might be there? I don't know if Alfonso, I know you probably have to leave us in a few minutes, but do you want to pick that one up first?
I guess I'll leave it to them. I have to go head out because it's late in Singapore, and I have more commitments. But I think that you have a parterre of great practitioners, and they could definitely help you out. I'm going to tell you the one thing. 10 years from now, I hope I won't be writing about infrastructure. But maybe
we're very glad that you did.
Maybe my colleagues will. Okay.
I think if I was to add to Alfonso, I think no one could have predicted that Truth Social was your better risk tool than your Bloomberg terminal. I think that's one of the big ones, right? I think that isn't, and clearly when we released the brief, it was before the February 2026, chaos that ensued. So I think we didn't really.
Who was the economist that said, in the long term we're all dead, right?
Yes.
Exactly.
I forget who it was, but they were right. Yeah.
John Maynard Keynes, I think.
It probably was Keynes. Yes. It's always safe to say Keynes when you don't know. Yeah, exactly.
But I think that risk, you call it political risk, I don't know, key man risk in politics, that is something you just can't plan for. And I'm not sure how you model for that either. There's many things you can do, but earlier we were talking about the Gulf, and if you think about the immediate impact after all the stuff that happened in February, 20% of global seaborne oil trade, 90% of global LNG trade all goes through the Strait of Hormuz. The IE said it's the largest disruption in history to global oil markets. That is unprecedented. That is a 4 or 5 sigma move that is very, very difficult to capture. So my answer would be, I think if you can have a risk model for the Tangerine Man, then that would be very, very good. I'm not sure that's going to come into existence anytime soon.
Can I say one more thing before I hop off? Guys, remember during the Ukraine crisis, right? Back in 2022, when we had the massive spike in LNG. And then the politics found solutions faster than we thought it would. Right. So don't underestimate the adaptability of the human race. And I'll end up with this, and I'll leave you guys to discuss the rest.
Thank you so much, Alfonso. I think you're right. I think the sort of human capacity for ingenuity and to take on new information and respond to new information is perhaps underestimated.
Could I just jump
in? Sort of what makes financial markets fun, I guess. Simon, sorry.
Yeah. No, I mean, just jumping in, I actually gave it some thought once you were speaking, and I think, I mean, if we look ahead and see also in the back mirror what is likely to be vastly different in the 10 coming years, there's a heck of a lot of things we will not know. But I think one thing we can probably most agree on is that the rates environment in the coming 10 years is going to look vastly different compared to the relaxed monetary policy situation that we've been in since the great financial crisis, with zero or sub-zero rates by and large. I think Alfonso alluded to this, and this is a conversation he and I has had for the last couple of weeks on a different topic. But it's that I think in a zero rate environment, clearly renewables are going to look very compelling. I mean, if you disregard the fact that we've had the political push for the energy transition, but also from a return standpoint, because the difference, if you compare it to a fossil fuel driven generator, which has huge operational expenses throughout its economic lifespan in the form of fuel inputs, the renewable power plant will have most of its costs during its lifespan fixed upfront in 70% on average in capex costs, right? So now, if depending on if you use a weighted average cost of capital of 3% or 10%, that's going to have a significant impact, of course, on the valuation metrics of that, and therefore the feasibility of the asset as a compelling investment. And I think this is something which we probably should keep in mind, and that we should recognize that this was a paradigm of easy money that is likely not coming back, and how will that impact the unique features of what the clean energy and the other types of infrastructure classes or assets, what that will impact on them.
Yeah. Matthieu, I don't know if you want to add anything to that, but and then we might just turn to data centers, because we haven't really talked about data centers at all. But...
Yeah. Generally speaking, I feel the biggest risk is during construction. And we saw that during COVID, for example, when supply chain is disrupted, be it for a short while, there is a spike in cost of procurement, which then heavily impacts all the economics and the financial plan of these infrastructure projects. And so this is really the black swan type of event that can completely disrupt a value chain. Other than that, infrastructure is here to stay. We see it's a way for countries to be competitive and to move up the value chain. And therefore, there is a need, there is capital. The cost of that capital may vary from time to time, depending on interest rates and risk return. But overall, there is certainly a need. The problem, of course, is when there is a regime change, as in a new paradigm in terms of costing and cost of capital. That's where things become more difficult, but historically the markets have adjusted. Thank you.
And maybe just to turn to data centers for a moment, because clearly sort of the rise of AI is something that many people are talking about, and the demand for both sort of power and the data center capacity to support that. Is that when did you start to see, or have you started seeing a sort of a significant increase in projects in that space coming to you? And when did that start, and how is it developing?
Well, maybe I can start, and Simon and Phil can easily complement. We've seen a very strong push towards digital infrastructure in the past 3 to 4 years. Being a German bank, Germany was relatively under-equipped compared to its neighbor and other European countries. What we've seen is first some relatively easier projects with very strong return for the risk. And little by little, as the asset class grows, we are experiencing price compression, increased competition. The asset class is drawing in more and more lenders. The risk is also starting to increase. For example, with the majority of data centers being used by hyperscalers, and therefore you run an indirect exposure to the very large US tech companies, who are definitely creditworthy and strong players, but we see how fast things can move in that space. Who remembers Lycos, Netscape, and all those players? Even Yahoo was big and is almost extinct. Therefore, this is a risk that we're seeing for the future, and as financiers, we need to adapt and be discerning enough in where we put the money and what we finance.
Yeah, I would add, there's a stat I read recently, and it was talking about how I think global greenfield foreign direct investment was over 20% was dedicated just to data centers. And it's even more if you look at certain economies like India, Brazil, Southeast Asia, where they're clearly trying to get a big chunk of that race and have a big part of that pie. So I think to Matthieu's point, I think that's just accelerating. And I think that equally, I think emerging markets as well as developed markets are hoping to enter that race much more aggressively than they have done in the past.
Simon, I don't know if you want to chip in. Yeah.
Sure. I think the interesting development that we've seen as of late is obviously the political push in the US, which goes to the issue that was mentioned earlier around affordability. I mean, there has clearly been recognition from the political side that the extreme demand driven by these slurping data centers will impact retail prices and therefore the average household bill. So I think you have seen papers circling around the mandating of what they now call for power islands, which is essentially off-grid or decentralized power production co-located with data centers. I think that is certainly an interesting development to follow in this asset class. And I think this will obviously have a fundamental impact on the overall power market if it gets realized, because then suddenly you're taking a lot of the demand in your grid essentially offline. So it's going to be interesting to see how that dynamic plays out. Above that, I just note that in the Nordics, yes, we've seen tremendous increase in appetite for for digital infra. I think here there has also been a political debate. I think we've seen a lot of these mega industrial projects being prioritized, such as Stegra, which was just out in the press today, saying that it has raised new fresh capital from the Wallenberg family, since they have been in dire straits for some time. And then, of course, we had the bankruptcy of Northvolt, and I think this is something which is due to the fact that while data centers can be quite compelling and appetizing investments from the political angle, they are of course less labor generating. So there are less people to be employed from these assets, and that's of course something which may cause political concern in terms of how you deploy and subsidize these projects.
Yeah, no, thank you. We'll wrap up in a moment, but I just wanted to ask you each to comment on what would you like a reader of the brief in particular to take from it? Let's just go with that. We'll keep it very simple.
I guess
okay.
What this brief is for people who are wondering what infrastructure debt is and are potentially considering either working in it, investing in it, just comparing it with other alternatives in terms of asset allocation. And so the first thing is that they should see, hopefully, that this is a very diverse asset class that has its commonalities. And this is why it's one asset class and not a hybrid between different asset types. So there is the emphasis on construction risk. There is common points, common traits in terms of economics, that once it's built, it's generally much easier to run. The various places where leverage comes in. And so when we say infra debt, so it can mean project finance, it can mean refinancing of an operating project, but it can also be development financing, which is a completely different beast in terms of risk and also in terms of opportunity. And so diversity, and one brings what makes it such that it's all infrastructure debt in the end are two key takeaways that I hope the readers will keep.
Yeah, I think if I was to piggyback on Matthieu's words, I think that infrastructure debt has its own unique characteristics, its risk characteristics. It's different from corporate credit and real estate debt. You don't need to clump it all together. It's longer duration, stronger covenants, typically has tangible collateral, low correlation with business cycles, historically very low default rates. I think it's about time now that if you're an allocator to really think about how you can treat infrastructure debt in its own distinct sleeve, and then build around that its own appropriate risk frameworks and benchmarks. And hopefully that brief will give you some of the tools you need to think about it in that context.
Yeah. No, I completely agree with former speakers, but if I can supplement that with something slightly different and a bit tangy, I guess I would also, and I think Matthieu alluded to it somewhat, that is that the target audience here is not really only practitioners, of course, and your institutional investors that may start to invest in this asset class, but it's also getting people encouraged and inspired around what is a very important part of our economy and what really makes our world spin, right? And I think we have lived in a period of whether it's fooling yourself of things, or whether it's some other reason, but we have sort of been dematerialized. We have lived in the financial world for such a long time, such that things that actually materials and things that actually exist and makes the economy spin are sort of forgotten. And I think this is partly about bringing the audience and the reader, and in particular those who might not be well versed in the field of finance as of yet, to get excited by that this is the revenge of the physical world, essentially, and I think it's not going away. And that is what I think the breakdown of the global order and the fragmentation and the reorganization of the geopolitical realities are underpinning or underscoring. So that's I guess how I would also add to what I hope is taken away from this brief.
Great. Well, I'm delighted that the world of the CFA brought you together. And on behalf of CFA Institute's Research Foundation, I'm very grateful for the brief. And I look forward to seeing the movie of The Revenge of the Physical World. And I will reread your brief again with that in mind. But Simon, Matthieu, Phil, thank you so much. And obviously to Alfonso in his absence. And I look forward to catching up with you all again soon. Thank you so much.
Thank you
for having us.
For more information, please visit rpc.cfainstitute.org/research-foundation.